Montgomery Community Media presents Small Business Network, brought to you by M&T Bank. SBN is also sponsored by Montgomery County Economic Development Corporation and Leadership Montgomery.
Hello and welcome to Small Business Network, presented to you by M&T Bank. My name is Taylor-Leonard. In addition to being the host of this amazing monthly event, I'm also the CEO of Taylor-Leonard Consulting. Each month, we bring the business community together to network, to collaborate, and to share best practices in an effort to stimulate regional economic development. Thank you to everyone that's joining us here in the studio as well as on the live stream. Today, it's tax week, and we will have a discussion around the good, the bad, and the ugly of the Tax Reform Act. And joining us is this distinguished panel of tax attorneys from Stein Sperling. So I'd like to introduce these gentlemen before we get into our conversation. So first up, as chair of Stein Sperling's Tax Practice Group, David Zhang brings a high level of expertise to his personal and customized approach to helping businesses and individuals with a broad range of tax planning and federal and state controversy matters, estate planning, business transactions, and valuations. Welcome, David.
Thank you.
Stein Sperling tax attorney Mark Schweighofer.
Hardest thing you'll do all day.
I know, right? Creates customized solutions that provide transactional tax and business advice in matters related to entity formation and structure, including drafting partnership agreements, limited liability company operating agreements, and stockholders agreements. And last, but certainly not least, is Steve
Wittes, close enough.
Steve Wittes. Steve Wittes is the co-chair of Stein Sperling's Tax Estate and Trust Practice Group. He builds highly individual and effective estate plans that give his clients peace of mind, which is important. He works with clients in the areas of estate planning, estate and trust administration, and tax and business succession planning. He also assists them in protecting assets for future generations through long-term trusts for children, as well as pre- and post-nuptial agreements. So welcome, gentlemen.
Good morning.
Hey, good morning.
Thank you for joining us. So wow, what a week, right? So I know this is a little bit off script, but because we had this sort of glitch in the tax system this week, what are your thoughts? Like, what happened? It was like a computer error or something that happened at the IRS that caused the deadline to change slightly?
Yeah, IRS's technology is not equal to that of the people in this room here. And IRS and taxpayers paid the price, but everyone was given an additional day to file federal taxes and Maryland taxes as well. But that passed at midnight last night.
Oh, wow. So it's a new day, right?
It is.
So let's jump right into this. So David, what has happened when we think about this whole tax reform? What's happened to our individual tax rates? Have they really gone down? Because a lot of us were hearing these stories. People are tweeting or you're on social media, oh wow, now I can afford my Netflix subscription or something like that. What has been overall the overarching impact from an individual perspective?
For most people, tax rates have gone down a couple of percent. People who were in the 12% marginal bracket, meaning the rate at which their last dollar of income is taxed, are people who were in the 15% bracket are now at 12. People who were in the 25% bracket are now at 22. But single individuals with higher incomes are seeing a rise in their marginal tax bracket. So not everybody got a tax cut. The highest tax bracket was reduced from 39.6% to 37%. So the wealthiest taxpayers are getting a cut as well. It's unmarried individuals, upper middle to upper income, that will be in a higher bracket, and the alternative minimum tax. Many people whose incomes are, say, from $150,000 to $750,000 have had to pay additional tax in recent years because of changes in the law. Far less people beginning in 2018 will be paying an alternative minimum tax.
Okay, so you mentioned single adults. So they may need you, Steve, like drop a prenuptial agreement so that they can reduce their tax bracket, right? Just a little tax humor. David's like, that's not funny. So yeah, so the single folks need to get married, right? There's benefits outside of the happiness that marriage brings. You can reduce your tax bracket, right?
Often two upper income people marrying will pay more in taxes instead of less. Some people may want to time their wedding dates to be married in January rather than in December.
Oh, gotcha. See, there's a good tip. Awesome. Thank you. So I think on another similar matter, so most of us are aware that there's this $10,000 cap on deducting personal taxes. What are the major changes in terms of itemized deductions, like our charitable deductions, things like that? What are the major changes that we should be aware of?
Well, you mentioned the most significant change to Marylanders and others. You'll figure your personal taxes in the same way as before, but no matter what that number is over $10,000, your deduction for state income taxes and property taxes together is going to be capped at $10,000. The home mortgage interest deduction. You previously could deduct interest on up to $1 million of loan and an additional $100,000 in so-called home equity indebtedness for new acquisitions after mid-December of 2017. That cap goes to $750,000. It goes down, and home equity indebtedness will only be deductible, that interest, in very limited circumstances. A big change is the elimination of miscellaneous itemized deductions, the last lines on Schedule A. People who have unreimbursed employee business expenses had better seek a new deal with their employer because they're no longer going to be deductible. And certain education expenses previously deductible, for example, somebody going for an MBA, generally that's deductible because it doesn't qualify you for a new trade or business. No longer deductible. No more miscellaneous itemized deductions.
Wow. Wow, interesting. So that's a mouthful. I mean, that's significantly different than what many of us have grown accustomed to. And Mark, it looks like you're like chomping at the bit to want to jump in to say something on this topic. What are your thoughts on the impact of the
So on specifically with the loss of the itemized deductions, I think it's going to have an impact not only on individuals, but possibly also on charitable giving, because fewer people are going to be able, or will be able to give as much to charity and be able to itemize, and because they're going to lose a lot of that itemized deduction, because more people will be taking the standard deduction. So that's one of the other things. It's going to have a broader impact, not only on individuals, but I think on a lot of the charitable organizations in this country as well.
Wow, interesting. And I know a lot of your focus in the firm is on the business side, correct?
That's correct.
So in terms of, like, how does this all impact our business taxes? Those in business, are businesses going to pay less in taxes, or does it depend on how we're formed? So let's dig into that a little bit.
So I'll give you the tax attorney's favorite answer, which is maybe. And so there's two sort of general broad classes of businesses. There's businesses that pay tax directly, meaning the business itself files and pays federal income tax, and then there's businesses that they don't pay. They may file a tax return, but they don't actually pay taxes. The tax liability comes through and passes through. We call them pass-throughs to the individual owners. hopefully I'll get a chance to talk about about those businesses, which tend to be smaller at some point on this panel. For larger businesses, the biggest change that this act brought forth, as David mentioned, with the individual rates changing and going down, there was a sweeping change in the way the business tax rates for tax-paying businesses changed as well. Formerly, that was as high as 35%. Now it's down to 21% flat. So there's a big drop in the rates, and so you will see, I think, some tax savings for businesses who, although I will say businesses really monitored their tax situation and their taxable income and tried to get as low as possible in the past, they'll just have a lot more flexibility here. Now, on the minus side for this, there are some of the popular deductions that businesses were able to take in the past have either been eliminated or will be significantly curtailed or limited. Things like if you were to go out and if businesses go out and borrow money, particularly for large businesses, if they were able to deduct the interest they paid to their lenders, that's going to be limited going forward. So they're not going to be able to take the full benefit of borrowing. So the cost of borrowing will go up. In addition, things like meals and entertainment, which a lot of businesses do a lot of things for clients and for prospective clients. And in the past, you could write off 50% of meals and entertainment. Now, under this new law, they've eliminated the ability to deduct any portion of the entertainment part of that. So you can only deduct business meals, and there's also some question on how much or how restrictive and how narrow the IRS is going to be on interpreting what a business meal constitutes. So we're going to need some additional guidance from the IRS and the Treasury Department, but that's generally where we see it. So in general, I think the rates will go down and larger businesses will pay less, but it is going to be sort of fact dependent.
Wow, now it sounds like so much of what you're saying, there's still a little gray or uncertainty around it. When do we think, what's the timeline for getting a bit more certainty so that we can, as the business community, sort of plan how we're spending? Because it's what, April now.
Right.
So how do we do this?
I mean, I think we're hoping that now that tax season's behind us, we'll
Right.
get some guidance from IRS. But I will tell you, if I was that clairvoyant, I'd be doing something else for a living, probably. And so, but hopefully, I mean, it is a priority for IRS, and they are putting guidance out, but there's no definitive date.
And you mentioned earlier that you wanted to talk more on the small business, the impact of small business. And I would love for you to expand upon that, because when we look at Montgomery County overall, such a large percentage of our small business community is small business. It's individuals and or businesses that are under probably 20 to 50 employees. And so what would you say to those businesses? And then my second part to this question, let's say I'm contemplating going into business. How do I then respond in terms of the formation of my business?
Right.
What should I be thinking about in terms of, do I go sole proprietor, S Corp, C Corp, LLC, all those different things?
So yeah, for sole proprietors, S corporations, and LLCs that are taxed as partnerships, the biggest change that this new legislation brought forward is potentially, and that's a big word, potentially business owners will be able to take a deduction up to 20% of the income that business generates on their personal return. So that's a big benefit, and it will bring down their business tax rates a little bit. Now, that sounds very simple. I will tell you that this new piece of the legislation that was enacted is probably one of the most complicated provisions of all of the Internal Revenue Code. There are limitations on the ability to use that 20% deduction. Things such as what type of business it is, personal service businesses, so doctors, lawyers, accountants really are limited in their ability to use it. Consultants are really limited in their ability to use that. In addition, is you look at sort of what is the business owner's income level. Business owners at higher income levels may be phased out or may be subject to an alternative computation on that 20% deduction. So it's very fact specific, and it is also entity type specific. In some instances, which we don't have time to get into today, an S corporation, while an S corporation and an LLC are both flow-through entities, in some cases an S corporation is clearly the superior choice to be able to take advantage of this. Now, in order to do that, you really need to sit down and kind of map out where you've been, where you expect to go, and really try to make an informed decision. because there are so many variables. I think that's one of the things that this law did. The type of entity you were in and for tax purposes in 2017 is not necessarily the type of entity you want to be in 2018. And so I think it's really important to sit down with your professional advisors and do your homework on it and try and get to the right answer.
Wow.
So
there's a lot of moving parts there.
Very
oh my
much.
goodness. So Steve,
Good
let's
morning.
go back to individuals. 529 plans. Let's talk 529s because selfishly I have a child that's about to go to college.
Okay.
And so I would love to know more about how does some of these changes impact specifically plans like 529 and what are some of the things that we can expect, how do we plan, all that good stuff.
All right, with 529 plans, you're probably aware that the general greatest benefit is that to the extent it's used for college or graduate school, those amounts that, for example, in Maryland are done through T. Rowe Price, but I don't think M&T handles those yet. But in any event, the bottom line is, to the extent they're used for college, the growth in the income, a portion of them, are not taxed. Ideally, I hope you didn't start the 529 plan recently. You want to start it when the kids are early so that growth in income has a chance to accumulate. But the bottom line is the current rules up until January 1 was the fact that it could only be used for college or graduate school. Mm-hmm. The two main changes are, number one, that up to $10,000 a year can be used for elementary and secondary education expenses as well. Huh. So for that child, if he or she is in a private school, or I guess even public to the extent there's some form of tuition, I don't think they call that taxes, but there's tuition, it can be used to pay that up to the $10,000 per year.
Oh, interesting.
The other piece that was changed was that under what are called the ABLE plans, these deal more with when there are a disabled person, that it's a little bit easier and more enhanced to set money aside without having to go through a special needs trust, that people can accumulate and contribute up to $15,000 per year to put away for a disabled child, disabled person, and that money can then be set aside again without a supplemental needs trust or a special needs trust, and it's a little bit easier to put that money away and protect against governmental, still provide governmental benefits.
Wow, awesome. So I'm going to open up the floor. If you have a question that you'd like to ask any of the gentlemen, please make your way to the mic. I'm going to ask one more question, but please start making your way over to ask questions. Steve, while we're still on individuals, so some of us may be losing out on the itemized portion, but aren't, especially when we talk about those that are well off, aren't they going to be saving on estate taxes, or how does that all come together?
Well, let me talk about a couple of the basic rules and then the implications. Under the new law, somebody for federal can have up to $11.18 million and not have to worry about estate taxes. For a married couple, it's double that. In 2026, it's going to come back to more or less $5.5 or $6 million exemption. And again, for a married couple, it'd be $12 million. I hope for everybody in this room that's their problem, that they have to worry about all that.
Life is tough.
Kelly, I know it is for you. Yes. It's a major issue.
You read my mind. That's why I stopped writing.
That's right.
It doesn't apply to me.
And for Maryland, which was just altered to some degree last week with our new legislation that came out, the maximum is $4 million in 2018 to avoid estate tax. But next year it's going to go to $5 million and $10 million for a married couple. What's happened is the two primary ramifications of that is, one is most people tend to focus a little bit more about getting away from estate taxes. Are they putting in long-term trusts to protect their child in case they marry that turkey? I guess that's permissible under the station rules.
Yes.
Number two, they're worried about who might be their power of attorney. What happens for disability? Because sometimes estate planning is a little bit of a misnomer. As we're living longer, we have to worry about our powers of attorney, our medical directives. And For people that do have to worry about, so we can talk about your situation later, that do have to worry about the estate taxes, there's an issue that's a little bit different than one might think is it's become reverse planning. Might we want to hold on to those assets for some people? Because on death, if you hold on to them, there's a step up in income tax basis other than things like IRAs. But if those property items are held and captured in one's estate, rather than having gifted them to your senior in high school, then to the extent that's been done, on a later sale, it prevents a lot of the capital gains from being incurred. And those capital gains in Maryland can often easily be, through various taxes, about a third of the appreciation that's protected.
Wow, awesome. Thank you. Question?
Yes, good morning. I'm Suzanne Scheer with Raymond James. I wanted to ask as far as the elimination of the deduction for the unreimbursed business expenses. You mentioned talking to our employers to find out what we could do. From their perspective, is it still a benefit to them to deduct those, or has there been a change to that piece?
Yes, the employers will still, with some minor exceptions, be able to deduct their expenses that the employees may have traditionally paid. There are certain exceptions to that, but I think employment contracts will be written in the years to come with employers paying more expenses, whereas employees who particularly were out on their own, perhaps in marketing, will rely on the employer to cover those expenses, since it's going to be much costlier if the employee isn't going to be able to write it off with pre-tax dollars.
Thank you.
Good morning. Mark Avalon with Potomac Wealth Advisors. There was some movement in the tax code regarding small businesses and keeping their income under $310,000, depending on their structure, and to benefit from a lower tax rate. I think there's some phase outs above that number. Can you talk a little bit about what businesses might benefit from that strategy and how it's going to look going forward?
Sure. So I think it's going to impact a lot depending on the type of business that you have. Certainly in the past with C corporations, if you had lower levels of income in the C corporation, you would be paying less in the way of federal taxes. From the individual side, you'd be able to, obviously keeping your business income down is always justifiable in terms of wanting to maintain, wanting to pay as little as you can. With moving to with a flat rate from the C corporation setting, I think it's going to be kind of less of a concern, actually, because it's going to, the rate is flat across the board now. There are no graduated rates in the C corporation world anymore. So I think that's going to be, a big difference.
And for flow through entities, have there been significant changes to hit that threshold and hurdle? My CPA and I talked about my clients having sold in business for themselves to keep their income at, if possible, in this $310,000 per year range. Now there is above that a phase out to benefit from a lower tax rate, and to bunch up expenses in certain years if they were making more than that number, to then bring it down.
So you're talking there again about the 20% deduction under 199 Cap A, the one that I mentioned earlier. And yes, the businesses that are below that threshold. So that's one of the things where starting at that 315,000 level for married filing joints, you start to phase out on that 20% deduction. And so when you get to 415,000, you phase out entirely if you're in one of those professional service businesses, or you kick yourself into one of those alternative tests in computations in determining the 20%. So yes, anything you can do to sort of stay certainly below the 415 threshold means you'll get some part of it, because if you're below that 315 threshold, it doesn't matter what type of business you're in. And it doesn't really matter what your business income is. As long as you're below that, you'll be able to take that 20% deduction. So that's it. So obviously, trying to keep and maintain below that number will allow you to avail yourself of the 20% deduction to some extent.
Thank you.
Yep.
Hi there. My name's Erin Allen. I'm with Contemporaries, and my question is in regard to you mentioned the larger businesses, those that are taxed that their costs of borrowing are going to go up. I'm sure that my friends at M&T and I am curious about what about for pass-through organizations, for S-corps in particular?
So that test on the limitation is based on your gross receipts. And so if you're at $25 million or less, you don't have, that limitation is not going to be an issue going forward. But once you cross that threshold, that's when you have to start worrying about it. And that's where it comes in, and it's basically, and that computation is also, not surprisingly, somewhat convoluted and complicated, but it's basically you're looking at, what you can offset that against your business income, your business interest income that comes in, and then it's basically a function of a percentage of your business's EBITDA for the first couple of years. So for smaller businesses, the cost of borrowing, at least with respect to that, should not change. But for the larger businesses, that's where you're going to run into that limitation.
Thank you.
Yep.
Good morning. My name is Kelly Nugent from Clear Connections, and two-part question here. I'm a big LinkedIn user, and I got a lot of help from Taylor-Leonard on my LinkedIn profile. And I want to get the LinkedIn premium, and I think it's about $800, something like that. Will I still be able to deduct that next year for my taxes?
I don't know of any reason why you can't continue to deduct it.
Okay.
There was no change in the tax law, directly or indirectly, that should take away that deduction.
Okay. Big thing, I'm a sports nut. Like to take clients to sport events. Is that going away?
I'll defer to the gentleman on my right.
Maybe Redskins, Ravens, Capitals.
The business entertainment deduction at 0% has taken away, even if those tickets are used to take clients and referral sources to games. The business may still pay for it,
Okay.
but it will not get a tax deduction any longer.
Wow.
That's going to hurt a lot.
Yeah.
Sport event.
You're correct.
Because I was actually going to take you to a game for plugging me, but I'm not going to. Sorry, Callie.
Maybe a concert now.
This has been awesome. You guys are amazing. Thank you so much. I learned a ton, but the main thing that I learned is if you aren't engaging a professional to help you sort of navigate these new waters, you're probably doing yourself a huge disservice. And so definitely want to thank you all for your time and just your wisdom that you imparted upon us. And this concludes this month's Small Business Network presented by M&T Bank. We thank you all for joining us on the live stream as well as here in the television studio. We invite you back next month. Actually, next month, if you're a women-owned business, and so this is important for you all as well as anyone in the room. If you are a woman-owned business or you know someone who is a woman-owned business, make sure that they are here May 17th. We are going to have an amazing, distinguished panel of supplier diversity and inclusion leaders from Sodexo, from McCormick & Company, which is our spice company right up outside of Baltimore, as well as Freddie Mac, sharing how they want to engage women-owned diverse businesses and how we can partner with them to grow our enterprises. So be here. Same time, same bat channel, May 17th. Thank you again for joining us on the live stream. This concludes the Small Business Network. Have a great day.